Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Going through the comment section, reading a whole bunch of different comments. I wanted to make a comment on the comments. There's some people who are continually piling more money into uranium and other energy companies, and that's fine if you overweight it, but don't get too crazy on any one position. Don't get too crazy on any one sector. If something happens, you got to be somewhat still diversified because you got to make sure that you protect the capital too, not just get a little crazy on it. And I'll go over kind of what my holdings are and what my strategy is, because it seems like when people are new to investing, they kind of just go crazy sometimes. And you don't want to go crazy. You don't want to lose your focus and strategy. And what makes you money, and this is incredibly important here. What makes you money is you have to continually push forward. Continually push forward, get your accounts continually moving forward. And psychologically, it's easier to hold something when your account is more balanced moving up than it is to have these absolute up and down movements with volatility, because what that requires is extra patience. It also requires you to be a more seasoned person. You're going to have to be able to take the punches. And if you guys are, I'll step back again. I have a large portion in physical precious metals. I have a lot of money in real estate in terms of equity in a house and exposure to it. And then you have my trading portfolios, like my equities and stuff. Those portfolios, 40% of my net worth's in that, roughly, maybe more. It keeps getting larger. I put half of that is in 401ks, which is mutual funds, stuff that isn't too risky, royalty companies, stuff like that. The other half of that, so 20% of my net worth, is going after this more crazy stuff, the high volatility, swinging for the fence type moves. I have 20% of my money allocated to that. And as it grows, if I'm very good at doing this, it's going to grow very fast. Then I take money out of it and throw it back into precious metals or real estate. I'm continually taking money out of my higher risk portfolio and moving it towards lower risk, solid returning strategies. So my physical precious metals, I consider that to be two things. I consider that to be almost like my savings, and I'm using the swapping game, the ratios, to increase my ounces. So it's not just dead money. It's money that's growing it at the least risk, in my opinion, the least risk way to do it. If you look at Exeter's pyramid, gold and other precious metals are at the bottom of the pyramid. It has the least risk of default. It's not debt. It's a final payment. So when I look at that as money. Like, that is my storage of wealth. That is what preserves my wealth. It protects me. It's the thing that I can keep continually piling in using ratio swapping strategies to grow those ounces. And I have a diversified mix of gold, silver, and platinum at the moment. I used to have palladium in it, but that got a little overvalued in relationship to platinum, and I swapped it to platinum. But that's kind of how I view these things. And if I don't have a ton of money in the high risk, highly volatile stuff, your wealth continues to go forward. It's just boom forward, boom forward, boom forward, and you'll have years that are up and down. I'm not saying that won't happen, but I did pretty dang well on the physical precious metal side and increasing those ounces. The volatile side, you don't want to put too much money in it. You don't want to put 100% of your net worth in it, because I mean, you could get hit. And if you lose 50% of that portfolio, to me, it's a 10% hit on that one section. It could be 10% of my entire net worth. And if you keep piling more in it, it could be 50% of your entire net worth if you put everything in it. And that's psychologically, that's a hard hit. So if you guys are going after the more volatile stuff, I'm just saying, be careful how much you put in there. Be careful how you set this up. Your strategy, I think, in my strategy is to spread it out amongst the most undervalued, best risk reward areas that I can find that has leverage on that side. And then I have the low risk spot of swapping metals. Keep that thing, in the background rolling forward. So what you want to do is you want to use that the higher risk, higher volatility. At least this is my strategy. I use that to make money quickly, and then I siphon it off and put it back into lower risk stuff. Maybe I'll buy like royalty companies, or maybe I'll buy diversified mining companies, or maybe I'll buy stocks when the time's right, or I'll put it into physical precious metals. I like putting it into physical precious metals. That just seems like it's off the table, and it's somewhere where I can't really see the account value. It's just bars and metal and holdings. I don't see this go up and down in front of my face, on a screen. There's no real impact to my psychology. I just see more ounces stacking. I'm like, oh, this is awesome. That's kind of how I measure my wealth. Is you measure it in how many ounces you're stacking. And here in the high volatility portfolio where I'm doing this type of analysis and using ratios and pushing the lever, I'm not pushing leverage in terms of I'm not going and borrowing money, but I'm pushing the volatility, and the companies are leveraged with debt to push my returns forward. And if you're using this strategy and your 20% portfolio here is not being larger than your, let's say you're doing better on your physical metals and you're not doing very well on this portfolio, that means that you need to really work on something. That you're not performing as well as the physical, and maybe you should just put more of it in the physical and use less until you become better at actually finding these companies, using technical analysis and the ratio game. But that's kind of how I view these things. Small amount goes into the big volatile, risky stuff, and then siphon it over to something else. Maybe you siphon it into real estate. Maybe you start buying and renting real estate. Or maybe you buy something like in the real estate, like REITs or something like that. Just siphon it off into other areas. Stay diversified. Don't go all in on one thing, because if something happens to that one thing and you have the majority of your net worth in it, you can get slaughtered. And that's what I don't want. I don't want anybody to get slaughtered here. So when I'm reading through all these things, I know some people are really starting to pile into energy. Just be careful, because energy has the most leverage to the upside. It also has the most leverage to the downside. So be careful on how much you put in there. So I just wanted to cover that and make sure that you guys are not getting too over leveraged to one sector, too exposed. And stick to a strategy, guys. Stick to a strategy. Create a strategy and be disciplined and use it. Don't veer off and chase gains, because that's what you're doing. I'm gonna call some people out on here. I'm not gonna say names, but you're chasing gains. Well, I'm gonna put it all in uranium. Oh, I'm gonna put it all in oil and uranium. Well, guys, that they've done very well, yes, and I think they will continue to do well. But don't go 100% in anything. That's where you're gonna get caught with your pants down. It's not gonna be pretty. Stay out. I think gold and silver, the precious metals group, looks fantastic. I've been adding me personally. What have I been doing with my money? If you're going to ask that question, what am I doing with my money? I have not sold anything in oil and gas. I have not sold anything in uranium. I've been actively buying small silver mining companies. I've been buying physical platinum for my holdings. I bought actually the most amount of money went into physical platinum. And I'm continuing to acquire physical platinum because I don't think we're going to see these prices again. I think when it was in the 900s, I just kept buying this entire time, hoping that it would stay down, so I can continue to add into the physical metals at these prices. So I've been buying personally these past couple of weeks physical metals, and I've been buying gold, silver mining companies, and I've also added into, this is over the past few months. When you look back, I haven't really been piling into uranium that much. I've been holding off a little bit, and I've been putting more into, like, say, a Nova Royalty or a Teuton Resources. Some of these companies, and I think they're still excellent to look at. And in the royalty companies, even Sandstorm Gold, they're down, guys. And EMX Royalty, I've been putting in money into those. I've been beefing that up because they're down. Do not chase price. Chase value. Chase a good pattern where it's about to break. I think gold and silver, we just broke to the upside. We're probably going to come back and give it that pattern a kiss goodbye. And that's the time you buy it. You don't go chasing, don't go chasing waterfalls. Don't be doing that. Don't be chasing returns, the price movements. When things go up, they're going to pull back. So when things have pulled back and they're down and people lose interest in it, that's when I start buying. I start accumulating. I'm not selling things. I'm in a accumulation mode for this market that's coming. Higher highs, higher lows. We're going to walk our way up. And I want my account to walk its way up. And whenever I feel like I'm a little too overexposed in something, I buy more of the thing that's down. I have pretty large holdings in oil right now because they've gone up so much, and even uranium. I got to start piling in some of these more, we'll call it the higher leverage silver miner companies because they're down. So I got to really hit those. If you guys like this type of analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.